If you have an FRS pension, it's easy to look at that monthly number and to feel some relief. Maybe your estimate says your pension's going to be $3,000 a month or $4,000 a month, and maybe that's enough to cover a big part of your retirement expenses. And that's a huge advantage. But there's one question people often do not ask early enough. And that's, will the same pension check today feel like enough 20 years from now? Because retirement's not just about having income today, it's about having income that can keep up with the cost of living. So this video is for you if you're counting on an FRS pension as a major part of your retirement plan and you want to understand what inflation could do to your spending power over time. Before we get started, just know comments are turned off for compliance reasons, but if this video is helpful, please like it, subscribe to the channel, and share it with someone else who's getting closer to retirement and is part of the FRS system. As you watch, think about this. If your pension check stayed the same for the next 20 years, would your lifestyle be able to stay the same too? Because that is what we're going to be talking about today. When people think about retirement risks, they usually think about the market. They worry about a recession. They worry about their investments going down. They worry about if they've saved enough. And yes, those are real concerns. But inflation is one of the 5 major retirement risks because it can quietly reduce your buying power over time. And it doesn't show up all at once. It happens very gradual. The cost of your groceries goes up a little more every single year. Insurance premiums go up. Home repairs become more expensive. Travel costs go up. Healthcare costs rise. And eventually that same paycheck that felt very comfortable in year 1 of retirement may feel tighter and tighter in year 10, 15, or 20. That's why inflation is not just an economic headline, it's a retirement planning issue. Let's use a simple example. Imagine you were to retire today with a pension of $3,000 per month. And at retirement, that $3,000 may cover a large part of your basic living expenses. Now let's assume that prices rise by 3% per year over the next 20 years. But your pension is still paying $3,000 per month. So your purchasing power is going down. And in today's dollars, that $3,000 monthly pension is going to feel more like $1,600 per month after 20 years. So same pension, very different buying power. And that's the part that people miss. Because this income, if it's not enough to keep up with your lifestyle, then we have to address that inside your retirement plan. Think about how you spend your money now and think about maybe a few of those basic things like groceries, homeowners insurance, car insurance, healthcare, travel, going out to dinner with friends. Now imagine what those costs are going to feel like 10, 15, 20 years from now. So we don't need to predict every number perfectly, but we just need to realize that retirement costs are not going to be flat forever. And that's why a pension, while it's very valuable, cannot be viewed as the whole retirement plan. It's a foundation, but the foundation may need support later on. Now, this matters even more for FRS members because not every retiree is going to receive the same cost of living adjustment. If you retired before July 1st, 2011, then your FRS pension plan benefit receives a flat 3% COLA, cost of living adjustment, every July. If you have service hours both before and after July 1st, 2011, then your COLA is going to be calculated by how many of those service hours or years were earned before that date. So that means that, yes, while the FRS pension used to have a cost of living of 3%, that does not mean you're going to have 3% today. A lot of clients I meet with today may find that their COLA is 2% or 1%. And absolutely, is that helpful in your retirement plan? Of course, but it's not going to cover everything, and it's not going to help with overall inflation, especially when we have inflation at 3 and 4%. That's why we want to have a plan for inflation today. Many people can make retirement work make retirement work in those early years, right? You have energy, you may travel more, you're gonna have maybe fewer healthcare expenses than you expect, maybe your home's paid off, so that pension income is gonna be higher and it's gonna feel like a very strong part of your plan. But inflation risk often becomes more noticeable later on, and the issue is not always that someone runs out of money, it's that they slowly have to make more trade-offs, right? Maybe you have to travel less, delay home repairs, stop helping children or grandchildren, and maybe they have to become more cautious about spending because everything just starts to feel tighter and tighter. It doesn't feel good. No one wants to be in retirement that way. That's why retirement planning should not only ask, can I retire now? It needs to ask, is this plan going to support me in my lifestyle for the next 10, 15, 20 years from now? The first is to make sure that not every dollar is positioned not only for today, but that we're thinking about that future income. Some money may need to provide income, stay liquid, but some money should be used for growth. I think of it like having a longer term job, which is going to be to help your purchasing power keep up over time. So this may include having investments that are designed for long-term growth. And the key here is balance, right? You don't need to have all of your money taking on market risk, but we want to have balance where we have income today and then we have assets that are still growing on your balance sheet to help offset inflation in the future. The second is flexibility. The pension may be fixed or have a small cost of living adjustment, but other assets are going to give you options. This could include deferred comp, IRAs, Roth accounts, brokerage accounts, drop money, other savings. And the question is not how much do I have? The question is which accounts can help support me if my costs rise later. Having different income stream sources can make your retirement plan more adaptable. The third is to plan for future expenses on purpose. Many people underestimate how much healthcare, home maintenance, taxes, and inflation is going to impact the later years of their retirement. A good plan does not assume every year will look the same. It stress tests the future. What happens if costs rise faster than expected? What happens if one spouse needs care? What happens if taxes increase? What happens if your pension doesn't cover enough of your income over time? This is what a retirement rehearsal is all about. We don't want to wait and find out later. This is something we want to test in the plan now. The biggest mistake is assuming your pension alone is going to solve this retirement income question. Again, your pension is going to be a major benefit in the foundation of your retirement, and it's a very strong piece of your plan, but it needs to work alongside other buckets. So think about your pension and Social Security being a baseline for your retirement income. And then this way, your drop, deferred comp, other savings can then provide liquidity, discretionary income, liquidity, and long-term growth. Each piece should have a job, and one of those jobs is helping you keep up with inflation over time. Here's the question I want you to take away from this video. If my pension check stays the same, what part of my plan is designed to grow? That is the question that helps you see whether your retirement plan is built only for the first few years or built for the full length of your retirement. Because retirement is not just about getting there. It's about staying comfortable after you arrive for many years into the future. Inflation is one of the 5 retirement risks that I'm going to be covering in more detail on my upcoming webinar on Wednesday, September 23rd. This webinar is called The 5 Risks in Retirement. And I'm going to have 2 sessions that day, one at noon and one at 6 p.m. Eastern. We're going to be talking about inflation and market risk and taxes and healthcare, and also the risk of outliving your money and how these risks can affect an FRS retirement plan over time. You can register for the webinar by using the link in the description box below. And before you go, ask yourself, if the prices of my life, my cost of living keep rising, what part of my retirement plan is designed to rise with them? That question is worth answering before retirement, not waiting until 20 years into the future when it now becomes a problem. If you'd like more information, make sure you click the link in the description box to sign up for my next webinar that's going to be all about the 5 financial risks in retirement. See you next time. Bye now. If you're ready for a more detailed walkthrough, then join me at my next live webinar. Use the link below to register for our next event. See you there.